Well, stock picking is always a hunt for value, but where can you find it with the market near record highs? Dominic Chu went sleuthing. Here's what he found.
Hunting for discounts in the stock market for many investors comes down to one important measure: price to earnings, or PE ratio. Simply put, it tells you how much you pay in stock price for every dollar of earnings that a company generates. Some sectors are getting even more attention than others as value plays if you look at price to earnings ratios.
First of all, you look at the financial sector of the market, and that's probably got the lowest price earnings multiple. And so quite frankly, if earnings turn out to be as good as a lot of analysts are expecting, then that's probably the cheapest.
Financials have lagged the overall stock market and are a big part of the S&P 500. But is PE the best way to value a stock?
In simple terms, is there a better way? No, P&E is probably the best way. The P&E multiple is the best way, but you always have to factor in growth.
Among Hogan's top picks are stocks like Gulfport Energy and Bancorp South. So you can't just look at a price to earnings ratio and make any kind of a judgment. You've got to put that number into context to see if investors are willing to pay higher prices for stock.
Clearly, if the growth rate of earnings or the prospects for the growth rate of earnings for a company are very, very bright, then it justifies a high price earnings multiple. And when prospects for earnings are not particularly bright, then you probably have a price earnings multiple is very low.
Earnings season kicks off this week, and corporate profits and growth rates are going to be a huge focus for investors. That could help determine whether the market goes higher from here or takes a bit of a pause. For Nightly Business Report, I'm Dominic Chu.